Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are looking at the energy sector. We haven't actually spoken about the energy sector a lot in this channel for a lot of reasons, some which are obviously the fact that renewable energy will be better in the long run, this and that, and environmentally friendly, all that stuff. But as an investor, sometimes you have to manage your portfolio and you have to think about what is best for your own portfolio. And obviously you can think about the other side of the ESGs and all of that stuff and looking out for the environment. But you also have to think about what are some of the companies that could potentially make you some money that are Sharia compliant, for example. So I just got started thinking about what I could potentially add to my portfolio just going forward, and I want to share with you, based on my research, 5 companies today. I'm not necessarily saying these are the best 5 companies or you should invest in them right now, but I want to show you the reasons why we are looking at the energy sector. When you look at the year to date, okay, the performance of the S&P 500, the best performing sector basically this year, since the beginning of basically January, whatever, it's actually energy. Some of the companies in the energy sector are almost up 40%, 30%, 29%, almost, every single one of these companies are up at least 30%. So it got me thinking, okay, these guys are up 30%. The companies like Nvidia is down 40% almost. Okay, so, and Adobe's and so on. So I thought, you know what, let's have a look at what these companies have done previously, okay, maybe in the last 5 years, whatever, and how they performed and so on. So that's what we're going to look at quickly, just to kind of show you the annualized. So since 2007 to 2021, okay, when you look at the overall S&P 500 and different sectors and how they perform. So the green is the energy. So when you click energy, 2021, okay, they were the best performing sector. 2020, they were dead, okay. 2020 here, okay, there you go, minus 33.7%. They were dead. Basically, the price of oil went negative. That was unheard of at some point, right? So when you look at generally, okay, 2007, they were best performing. 2008, they were down almost to 35%. 2009, they were up about 14%. 2020, were up again. Again, it's basically not a lot, but up about 5% in 2011. 2012 was almost the same. 2013 was 25% up. 2014 was down 8%. 2015 was down. 16 was up 27%. 17 was down 1%. 18 was down 18%. 19 was up almost 12%. 2020 was down 34%. And 2021, it was actually up 55% almost. And right now so the total, okay, they have 41%, almost, let's call it 42%. So 2022, I'm sure it will be very similar to that, unless something happens between now and the end of the year. So I'm sure they will be up because they are already the best performing sector year to date. So I'm sure they will be doing well. Now, in comparison to that, obviously, when you look at information technology, they are up so much. And every single year, apart from 2018, okay, every single year, 2008, okay, 2018 and 2008 was the only time they were actually negative. When you look at consumer discretionaries, when you look at healthcare, when you look at all these other sectors, they're more or less up almost every single year. But when you look at industrials, for example, when you look at consumer defensive and so on, every single sector in here, by the way, I'll share this website with you guys. You can have a look at that if you would like to. But the reds are consumer discretionary, and then the kind of brownish is the consumer staples. So when you look at the staples, for example, which people say, oh, they don't perform that well, or they basically, they don't actually do well. Almost every single year, apart from 2008, I think, they were up at least 10, basically 7% or more. Okay, that's consumer. That's basically the Procter and Gamble's, Unilever's, and all of those companies out there. So it got me thinking. So looking at this, the energy is not doing that bad. Yes, they've had a couple of, a few negative years. Almost every other year they were negative. But when they're up quite a bit. And this year is actually no difference. I think it's going to do the same. So let's have a look at some of the companies that I actually researched about. And I thought, you know what, let's actually give it a go and see every single company in basically the best 5 companies in this sector and see if we can invest in them. Because you remember, these companies pay a lot of dividend, okay? Price appreciation is not as much, although in the last 2 years is up quite a bit. But if you are closer to retirement, so you've got, like, say, for example, another 5 to 10 years, whatever, these companies will be around for another 10 years. I guarantee you that much. They're not going to disappear overnight. Okay, it will take time. Okay, and again, some of them are already investing in renewable energy and all of that stuff. So they kind of diversifying and going away from the oil production and so on. So in the next 10 years, if you own these companies, okay, and for the dividend, you'll be happy just to get that cash. And I'll show you the type of money that you potentially might get from their dividends. Okay, so let's have a look at the first company. The first company is Chevron. Okay, this is the second biggest company in the US. They are involved in the oil explorations, productions, refining operations worldwide, and they are second biggest in the US. Right now, it's trading $160 per share. EPS at one point not long ago, I think it was December, whatever it was actually about $100 per share. It just kind of shot up from January onwards. EPS of 8.14, market cap of 306, almost $307 billion. None of these companies we're going to talk about today will have an economic mode better than narrow, okay, because they are oil big companies and anybody can actually jump into those kind of businesses. Obviously, you need a lot of capital, but they don't have a wide mode. They don't have competitive advantage over others, okay? In terms of capital allocation, they're doing well for this company, okay? Beta is quite low. When you look at the valuations, we're looking for PE, price to free cash flow, and enterprise value to EBITDA. These 3 kind of give us an idea, okay? It's oil companies is always good to use the price and enterprise value to EBITDA, and if it's below 10, that's actually a good thing. Okay, so that tells you is undervalued. Is above 10, tells you is overvalued at that point. But you have to also look at the industry, the sector generally, and compare it with other companies like for like. So you just have to think about in terms of price to free cash flow, PE, and enterprise value to EBITDA. All of these you have to take into consideration, the sector as well as actually in comparison with other companies. But all of them are basically under what we want right now. And the sector is only 12.53 at the moment. Okay, oil companies, to be honest, they are quite low in terms of PE at the moment. This is the sector PE, by the way. Dividend 3.64%, 5-year growth rate of 4%, 34 years increase. They have increased this dividend for 34 years. Payout ratio 65%, dividend safety 65%, free cash flow here $21 billion, over $21 billion. So they have enough to pay that dividend. That dividend is definitely covered. And the fact is only 65% payout ratio, that tells me there's a room for improvement. If they want to increase it, they can increase it. Dividend safety 65. Again, we're looking for anything above 60, so that's actually good as well. In terms of profitability and management effectiveness, okay, how the management is actually using your money, our money, okay, and the revenue and reinvesting in the business, looking out for opportunities and making sure they pay that dividend, buying back shares, all of that stuff. Basically, we're going to look at that now. Profit margin, okay, we're looking for above 10, about 15%, but it's 10 at the moment. Operating margin, again, 10. We're looking for anything above 12. Return on equity, we're looking about 15, but it's about 12 here. Total revenue, total returns. So this is basically in the last 10 years. This has basically given us, if you bought this, you would have got about 10-year returns of about 6.6% every single year. Current ratio, just above 1, which is what we're looking for. So they are not in debt. So they've got enough money to pay off their debt. And companies like The oil sector has a lot of debt, so you have to be really careful. In terms of valuation measures, based on the analysts, so what the expectations are from the analyst, okay, next 5 years, they're expecting this company to grow their earnings about 8.5%, which is very good. Simply, Wall Street says is 4% undervalued at the moment. They expect the price to be $163 per share. Morningstar valuations actually says fair valued at the moment and should be about $142 per share. Tip rank 7% upside, and it should be $168. According to Tip rank, okay, it's a moderate buy. Okay, that's if you go to their website, type CVX, you will see they will say it's a moderate buy based on what the analysts are saying at the moment. So that's the first company, and it's a huge company. They pay such good dividend, as well as that they have their profit margins are not that great. Okay, I would have liked it, but then when you look at the sector, I think it's quite similar. And we will see the rest of the companies now. The second company we're looking at is the biggest company in the US. Okay, ExxonMobil. This company is currently trading $186 per share. I'm 100% sure at some point, I think it was early 2000, this company was like $30-40 per share. They do exactly the same thing as Chevron. Okay, they basically explore, produce, and refine oil around the world, and obviously they have so much money in terms of so much investment in different countries around the world. Okay, EPS is $5.38, market cap $357 billion. Again, those two are, like I said before, every single one of the companies that we're going to look at today will have economic moat narrow, and capital allocation will be exemplary. Beta is actually quite low, PE 16, price to free cash flow just about 10, and enterprise value to EBITDA is almost 8, which is good. Okay, so according to this, it looks undervalued at the moment. Dividend yield 4%, above at 4%, which is quite high. 5-year growth rate 3%, dividend growth. So I don't like that, the fact that they don't actually grow that dividend as much, but because these companies tend to, obviously that's already high, the dividend yield. Okay, that doesn't really matter too much to me. Dividend growth streak is not almost 40 years they have been paying this dividend, increasing this dividend. Payout ratio 65, dividend safety 55. I think this is probably the lowest out of all of the companies that we have. But look at this free cash flow. So they got $36 billion. Now, one thing you really have to worry about is when it comes to oil companies, they use so much money. Okay, they can just go through that $36 billion in a couple of years. So you have to really be careful. It's not like the software company. If they got $36 billion, you know they're not going to be able to invest or use that money unless they are buying shares back, or like Google, for example. Apparently, they're buying $70 billion of their own shares back this year, which is absolutely ridiculous. But yeah, so they are capital heavy, so they use a lot of that money. Now, in terms of profitability, we're looking at profit margin of 8%, operating margin of just about below 10%, return on equity 14%, total return about 2.72, which is very low in my opinion, current ratio just above 1. Right, the next thing we're going to look at what the analysts think about this company, and the next 5 years they're expecting this company or the earnings to grow about 16%. Simply Wall Street says 24% undervalued at the moment. Fair value of $108 per share. Morningstar exactly the same, $96 per share. But tip rank is actually says is slightly up, got a little bit of upside, $91 per share. So again, moderate buy from tip ranks. Okay, and currently trading 86. So there's not that much of upside. Again, great company, the biggest oil company in the US. In terms of dividends, it looks really good. Although the safety is basic dividend safety is quite low, but the fact that they've got $36 billion, I wouldn't worry too much about that. But the margins for me are very low, and the returns of your investment, okay, total returns that is actually quite low from the last 10 years. Now, the next 10 years might look different. Okay, remember all of these things are in the past. Okay, so we're looking for basically stocks are always forward looking, but right now we also need to see the past in order to kind of have an idea of what the future would look like. So you have to think about that as well. The next company we're looking at is EOG. Again, the company does the same thing, exploring, developing, producing crude oil, natural gases, and so on. Currently trading $115 per share. And EPS almost to 8, $66 billion market cap. When it comes to economic mode and capital allocation, both narrow and exemplary. Beta less than 1%, less than 1, which is very good. PE ratio of 14.52, 12.6 price to free cash flow, enterprise value to EBITDA, you're looking about 7, which is actually not bad. And then when we look at the dividend, okay, dividend yield 2.66%, 5-year growth rate of 24%. They must have a lot of money in the bank. Dividend growth streak of 30 years paying that dividend, increasing that dividend, payout ratio 23, and then dividend safety of 82%. Okay, so that is percentage. So that should be a percentage, and then almost a $5 billion in the bank. Okay, so this, to me, so far what I've seen, this actually looks quite good. The fact that they're increasing that dividend quite a lot. This 2.6, so for oil companies is actually quite low. The dividend safety is the highest that I've seen, I think, so far. So yeah, interesting so far. Profit margin side of things, 23.6%. That's really good. Almost 31% operating margin. Return on equity 22. Total returns. This looks better. Okay, so profitability side of it, dividend side of things, it has less cash, but remember it's a smaller business, so only $66 billion. Okay, so that looks good to me so far. So valuation measures, we're looking about 11.7. We've actually analyzed this company a while back when it was trading, I think, less than $100 per share, I think. So that probably would have been better time to get in. But right now, 5 years, next 5 years, they're expecting almost 12% growth in earnings. Simply Wall Street, 21.7% undervalued at the moment, $142 per share. How much is it right now? $115 per share. Okay, not bad. Fair value when it comes to Morningstar valuations, and $108 per share. Tip rank says it's 145, about 29% upside right now. Again, according to Tip ranks, it says it's a moderate buy. So yeah, this looks all right. If you were interested, so right now, if I was interested in this, and I will be looking at their financials, look at where they get their money from, what countries they're involved, where basically their oil explorations, all that come from, and if they had any issues in the last few years, the free cash flow in the last few years, all of that stuff, just to learn about the business generally, who's leading the company, are they buying back their shares, and all of that good stuff that we normally look at. The next company we're looking at is Conical Phillips, currently trading at $95 per share. Again, they do the same thing in terms of product. They produce, transport, and market crude oil, natural gas, and so on. Currently trading at $95 per share. EPS about 6, market cap of $120 billion. So they are bigger than EOG. Again, beta in the economic mode and capital allocation look all right so far. Valuation measures in terms of this overvalued, undervalued, PE is quite low, lower than 20. Price to free cash flow is actually all right. Enterprise value looks good. So right now, this actually looks decent. Dividend yield 1.98%. It's actually quite low. 5-year growth rate. I thought normal oil price companies pay quite a lot, but there we go. 5-year growth rate 12%. Dividend growth streak 5 years. Payout ratio 29%. Dividend safety of 61%, if I can read. Free cash flow is actually quite good. $11.67 billion in the bank. So that's actually quite good. When we look at profit margins, 17.3, operating margin of 27, return on equity 21, total return in the last 10 years, almost 6%. And when it comes, current ratio is above 1, so they have enough money. Let's have a look at the evaluations, what the analysts are expecting right now. That's about 14.7% upside next 5 years, or growth, earnings growth in the next 5 years. Simply Wall Street says about 31% overvalued. The price should be $70 per share, and right now we're looking at about 95, so that's quite a lot. And then same thing from Morningstar, 16% premium, $80 per share. TipRank is the only one that's bullish on this, 127, and they have said it's a strong buy. Based on that, I wouldn't say it's a strong buy. It's probably a buy, if not just a hold, based on these two, because they are using intrinsic values, whereas this one is actually looking the analyst right now and what they're saying in the next 12 months. So the price might go up next 12 months, but then based on the intrinsic value of what the company is worth right now, it looks overvalued, and that's really important. Okay, so the next one is Pioneer Natural Resources. Again, it does the same thing, independent oil and gas exploration production company. Okay, explores, develops, produces oil, natural gas, liquids, and so on. Currently trading $233 per share. EPS just above 8. Market cap of $56 billion. Again, these three things are exactly almost identical to the rest of the companies. PE, this is the highest we've seen so far, 27. Okay, price to free cash flow, again, just below 10. Enterprise value to EBITDA, just above 10, which is what we wanted. What we don't want that, we want it below 10, obviously. And dividend yield, really low. 5-year growth rate, 96%. They must have started very recently. Okay, dividend growth streak, 12 years in a row. Payout ratio, so they have been increasing this for 12 years. That's very interesting. Payout ratio, 18%. Dividend safety, 55. That's very low. $2.89 billion of free cash flow. In terms of profit, almost 12% profit margin, 23% operating margins, or almost 24. Return on equity, 12%. Last 10 years, it actually returned. Total return was about almost 8%, and current ratio above 1. So it looks all right in terms of profitability, but dividend that doesn't look that great. And the fact that they only have $2.8 billion, that's a little bit worrying for oil company. But because the dividend is so small, they are able to cover, but that is actually 55%. So that's, to me, still low. Next 5 years, the analysts are expecting this earnings to grow to 17.2%. Simply Wall Street says 50% undervalued at the moment. Fair valued of 467. That's interesting. Morningstar fair value 222, currently trading $233 per share. So that is, the fair value territory really. TipRank 25% upside, 289, and they said TipRank says strong buy right now. Now that's the last company. So to me, out of all of them, to be honest, the one I'm really will be interested is EOG Resources. These two are very old. Okay, they've been around for generations, and I don't think they're going to go anywhere. I like the fact that they've got a lot of free cash flow. So Chevron looks good. Exxon, I'm not too sure. Okay, I'm not too sure. Even though they've got a lot of free cash flow, the dividend looks quite high. I don't know if they can maintain it. I'm sure they've cut down the dividend not long ago. Actually, they didn't. During COVID time, they actually didn't cut down. Now, so what would I do if I were closer to retirement and I'm not worried about, in the next 5 to 10 years, I want to basically get some cash, right? So that's what you're interested, that passive income. These companies pay really well, okay, and their dividends actually seem safe. They have a lot of cash, and if the oil prices and the share prices keep going up, then obviously you're going to have that price appreciation, just like what we've seen in the last 5 months or whatever. So you're going to have that, as well as obviously the fact that you're getting that dividend. So it looks really tempting, okay? And when you look at the last, since 2007, the returns haven't been really that bad, apart from 2020 was the only year that was really, really bad. And a lot of that was because of COVID. In fact, 2008 and 2020 were the only 2 years, basically, they had 30% or more down. Now, having said that, if you are doing a portfolio, obviously, management, you're going to have maybe some energy stocks. And if you had to have one, for me, if I had to have one, it will be either Chevron or EOG Resources. Again, I will do a little bit more research. And if I feel like, do you know what? It could add potentially. Right now, I feel like they're overvalued. I genuinely would not be buying. I'll be honest with you right now. These companies need to come down at least 10-20% for me to even actually look at them, because I knew about them, okay, when they were trading below $100 per share. Chevron, when Exxon was about 50 or whatever it was, when EOG was way below $100 per share. So for me to actually start investing in them right now, it doesn't actually make any sense. But if anyone out there is really interested in looking at, basically, I hope this was helpful. I hope that kind of gives you an idea of where they are, these companies. But in the long run, in the next 10 years, they will definitely be around. I guarantee you that much. Okay, despite what's going on in the world in renewable energy, the fact that we're moving away from fossil fuels and all of that stuff, I think these companies will be around. Anyway, that's my take on the oil companies and the energy sector. Again, like, I'm not a financial advisor. I'm just giving you some information that could potentially be useful. So just take it for what it's worth. Have a wonderful day. Assalamu Alaikum.